From Tycoon U Studios in Delray Beach, Florida, this is Options GPS with Chris Rowe and Ron Ianieri.
Hi, and welcome back to Options GPS. I'm Ron Ianieri.
And I'm Chris Rowe.
And today's backwards day. It's not backwards day, but remember, you just learned covered calls and rolling and morphing the covered call position. So we're going to do the reverse of that right now, and we're going to learn about covered puts.
Yeah, basically what people need to know is that it's simply the covered call in the other direction. We talked about calls and puts actually being the same thing and very similar.
That's right.
People seem to have no problem understanding how to trade calls, but then they all of a sudden become completely baffled on how to trade puts. And what they need to know is it's just a call in the other direction.
Right.
The mechanism is the exact same thing. So if you have trouble with the put, at least to start, think call, flip it around, exchange identities, and now you've got the put.
Well, I think that what might have happened over the years is that, you know, stockbrokers, money managers, financial advisors, they understand the covered call. And they don't understand that a call and a put is the same exact thing. So if you go to your broker who understands covered calls and you explain covered puts, probably you might be a little intimidated, him or herself.
Well, the other thing is, too, remember, you know, Wall Street makes money when the market goes up. They can't do crap when the market goes down except get crapped on.
Right.
And the thing is that, you know, they're never really comfortable with any type of downward movement. So for them, the covered put strategy is completely alien.
Right.
Because that's just not their world. Their world is the market goes up.
Right.
But that doesn't mean as an individual investor, you have to be blind to the fact that when the market goes down, there's just as many opportunities, if not more.
Faster opportunities.
And exactly right. Good point. Faster opportunities to make money. And you know, all you have to do is think about the mechanism of the call, and you have the put. It's just in the opposite direction.
Well, basically, you know, the media, the financial media helps with the financial industry, just training individual investors to only be bullish, because now it's just a matter of raising money. If I'm a financial advisor and I'm charging 2%, I just want to raise as much money as humanly possible. Performance doesn't matter as much to me. If I match the market, market's down 40% and you're down 40%, hey. It's the market's fault, right?
Yeah, and that's the gauge now. It's ridiculous.
They don't want you to think about making money on the downside, okay? But that's all about to change.
And you know what? Because if you make money on the downside, you are going to dramatically outperform them and make them look silly.
And fire them.
And then fire them and then take your money back and manage it yourself like you should be doing to begin with, to be honest.
All right. Well, let's get to it.
Let's get to it.
Let's talk about covered puts.
All right. Let's take a look at the covered put strategy. Now, off the bat, so that you know, we've been saying that calls and puts are really more alike than not alike. The actual mechanism of the two is identical. So if you're having trouble digesting the idea of the covered put, simply think about the mechanism of the covered call and turn it over. Because the same way that the covered put is going to work with the stock going down, the stock going up, the stock going sideways, it's the same way that the covered call worked. If you understand the covered call and you think about it, you'll understand the covered put. So the covered put, or as we call it on the floor, the sell right, is constructed as short stock, short a put in a 1-to-1 ratio. Think about that. Short stock, short put in a 1-to-1 ratio. The functionality of the covered put is the same functionality as the covered call. This is, first and foremost, a premium collection strategy. You've got to remember that. Although it does have a directional lean, it is a bearish trade. It really, first and foremost, is premium collection, just like the covered call. Obviously, being that it is a bearish strategy, we do a little better if the stock were to trade down, but we don't want it to trade down too fast. We didn't want the covered call to trade down too fast. We don't want the covered put to trade down too fast. Actually, it was the covered call we didn't want to trade up too quickly. That's how similar these two strategies are, I confuse them all the time. The mechanism is identical. So we are partially hedged here. We have a little bit of premium coming in from the selling of the put. That provides a little protection in case the stock would go up against us. That partial hedge is simply partial. It's not full. If the stock goes against us, starts to trade up by anything more than the amount of money we brought in from the sale of our put, then we are unhedged. This covers us a little bit. That's why it's partially hedged. In the same light, the covered call strategy was a repetitive strategy. The covered put strategy is a repetitive strategy. You have to sell that put month to month to month, every month, like clockwork, to really get the full power of this strategy. When we talk about premium collection, we know that it's only the extrinsic value of the option that decays. Intrinsic value does not decay, only extrinsic. Theta, as we know, is nonlinear. That means, as you remember, an option's extrinsic value does not decay equally over time. It decays in a nonlinear fashion. The closer we get to expiration, the quicker and more aggressively we see this extrinsic value decay. Theta becomes more and more powerful, eroding the value of that put away as we get closer and closer to expiration. As we've said on numerous occasions, the at-the-money option has the most extrinsic value in any given month. That means that if we're trying to capture extrinsic value, then that's the option we want to be selling. It's the one that has the most. Thus, it has the most to decay. We also know that the front month has the highest rate of decay. We've looked at situations where we've had an out-month option that, as months go by, it doesn't seem to decay until it starts getting closer to expiration. That's because the front month decays the fastest. And that is the month we're going to want to sell. Here's the extrinsic value decay chart again. We talked about this when we talked about the covered call strategy. And we're going to continue to talk about this every time we talk about a premium collection strategy. As you can see, out 5 months out, as a month goes by, nothing really happens to the price of our option. The extrinsic value is not decaying. Why? Because there's still so much time. But as we start getting closer and closer to the front month, we start picking up a little decay. Where we really start to see decay kick in, the first time it's noticeable. It's not that it doesn't exist, it's just not noticeable. Where it becomes noticeable is about 60 days out. Then around 30 days out, when that option becomes the front month option, decay really hits it hard. But finally, that last 2 weeks, especially the final week before expiration, this option is bleeding. We don't want to be selling these out-month options. When we do the covered put strategy, we want to sell a put that's over here, not out here. We discussed this, as I said, with the covered call. Why do we not want to sell that out-month option? Because it's got no theta. There's no decay. You take a look at two people, one selling a 5-month put, the other selling the front month put. The person who is selling the 5-month put, in the first month, from 5 to 4, that first month, there's no slope there. There's no decay. They have been short an option for a full month for no reason. If the person who understands says, hey, instead of selling that 5-month option, I'm going to sell the front month option 5 times. The first month, we get to see this slope. Look at the difference between the slope here and the slope there. We will definitely do much better than the person that sold the 5-month option. Look at the next month, from month 4 down to month 3. There's still not a heck of a lot of slope there. But someone who knows what they're doing would have sold the front month option again, a second time, collecting this steep curve. 3-2. We're starting to pick up a little slope here off of our 5-month option, but nowhere near selling this front month a third time. 2-1. You can see the point. We've discussed this with the covered call. The covered put really is a premium collection strategy. We've got to focus our attention to our theta. Where is theta largest? Because theta measures how much an option decays in a single day. Bigger theta up here, more decay. That's the month we want to concentrate our time in. Just look at the slope. I actually drew a straight line giving you an idea of the difference between the slope, the decay slope of a 60-day option for the first 30 days versus a 30-day option. Look at the difference. If you sold that 60-day option, look at the slope the first 30 days. From 60 days down to 30 days. Look at that line. It is decreasing, isn't it? I mean, comes down a little bit. But for the same 30-day period, you could have sold this front month. Look at the slope here you could have captured. Dramatically more steep than this 60-day option would have been. We want to capture this slope month after month after month. We don't want to bother with this slope. Give me 2 of these and keep all of those you want. We want to make sure that we're not selling out-month options for premium collection. They just don't decay fast enough. So let's take a look at our profit and loss potential of the covered put. In the covered put, we have a break-even that is calculated by the stock price plus the option price. In the covered call, it was the opposite. It was stock price minus. But for covered put, it's stock price plus. Why is that? We've got a short stock position. That position gets hurt as the stock trades up. Selling our put brings us money in, which protects a little bit of that adverse movement in the stock. So if we sold the stock at 30 and sold the put for 2, and the stock went up $2 against us, we'd have a $2 loss in the stock. But if the stock went up, the put we sold would expire worthless. We'd collect all $2 of that put. That $2 would cover the loss we had in the stock. That means the stock could actually move the opposite direction. It could go up against us. And as long as it doesn't go up by more than the put price that we sold, we'll break even. We might even make a little. But the put, the premium brought in, covers our upside by that amount. The stock moving up is what hurts us. So we have to take a look at the stock price plus the option price. We have to look at what happens if the stock would go up and how much protection's provided by our put. Where that put breaks us even is our break even, right? Stock trades up. If the stock trades up by the amount of the premium we captured in the put, that spot right there is our break even. Stock price plus option price. What is our point of maximum profit? I'm not telling you, because you did your homework. You reviewed the covered call. And if you reviewed the covered call, you know what this answer is. Where does someone who is short an option want the stock to finish at expiration? Right at the strike. True for any premium collection position. Remember we said take down this rule of thumb? Here it is. So what's the point of maximum profit? It's the strike price of the short put and below. For the call, it was the strike price of the call and above, right? The covered call said strike price and above, covered put, strike price and below. That is where our point of maximum profit is. What about our point of maximum loss? Here, we truly have a bit of an issue. Because when we're looking at the covered call, we said if the stock trades down against us, we get hurt. But the stock does stop at zero. Well, maybe not AIG because we've dumped another $85 billion in there. It doesn't matter. The point of the fact of the matter is that we have an unlimited potential upside. There's infinity to the upside. That means that if I'm going to lose dollar for dollar above my break even to as high as the stock can go, then I could lose dollar for dollar to infinity above my break even. Here's a chart of the sell right or covered call. What are we looking at here? Well, the first thing we need to look at is this. What is that? That is our unlimited potential loss. If the stock goes up against us when we're in the covered put position, we're going to get killed. What about the other direction? Well, we know that if the stock goes down, we make money. But that money is limited. There's a limited amount of money that we can make. What is this? That's the point of maximum profit. And of course, our break even. And the break even makes sense. It's above the stock price. There's our break even. Well, what about returns? Let's talk a little about returns. Our returns for the covered put position is the extrinsic value that we collect during the month. That is what our potential return is. Remember, this is a premium collection strategy. Our goal is to use our short stock position as our principal and then generate income off the principal. What is that income? The extrinsic value we collect from selling the put. So our return for the month is going to be the amount of money we collect versus the initial investment. Now, you might say, wait, well, there really is no initial investment. If I short the stock, cash comes into my account. Correct. So what are we going to do? We're going to take the dollar price of the stock. Then that will give us our potential monthly percentage return. Times that by 12, that could give us a potential annual percentage return. Remember that the percentage that we're looking at, the percentage return we're looking at, if it's a rare time, if the volatility is super high, and we're going to collect a lot of money in selling premium, we can't really say that it's an average month. We need to look at an average month to get a good idea of what our return will probably be for the entire year. You can't just take one specific month and say, oh, that's the one. It's got to be an average month in order to forecast what your return will probably be over the course of the year. Take a look at some return examples here. Short the stock at 60. Sell the 60 put for $4. What do we have here? We've got a maximum gain of $4. The premium that lies in our put. Now, if we had sold the stock a little higher, say if we sold the stock at like 61, and the stock closed at 60 at expiration, we'll collect our $4 of premium, but we might also collect a little bit of capital appreciation. Being that we're doing this at the money, normally you're not going to capture too much capital appreciation. You might make a little capital appreciation, you might lose a little during the course of the year. That normally weighs itself out and balances out over an entire year. What we're really trying to capture is that premium right there. Now, what's our percentage return? $4 gain divided by the $60 initial investment. That gives us a percentage monthly return of 6.7%. If this is an average month, if volatility is at an average level, then we can forecast this position to generate about 80% a year for us. If it's not an average month, then we can't think of it as being something we can depend on for a 12-month period. So remember, if you're going to try to guesstimate what your probable potential return is going to be for the year off of this strategy, make sure you do your guesstimate off of an average volatility level month. Let's take a look at the Greeks of the covered put. First, let's look at delta. Delta here in this position is going to be short. Remember, this is a bearish strategy. The stock going down does benefit us from our short delta position. Our gamma is also going to be short. Why is it going to be short? Because we are short an option. Remember, anytime we sell an option, put or call, we acquire a short gamma position. What about our theta? Well, theta is the key to this whole trade. We have a long theta. That means we will be collecting money as the days go by. As that option decays, we, the seller of it, the one that's shorted, will be collecting that premium. And what about our vega? Our vega is also going to be short, just like our gamma. How? Because when we sell an option, we acquire short vega. Doesn't matter if we sell a put or call. We become short vega. If you take a look at the Greeks of this covered put position, what you're going to notice is spare delta, the other Greeks are identical to the covered call position. The only difference here is delta. In the covered put, we're short delta. In the covered call, we were long delta. But in terms of the movement, the mechanism of how this position will react, both of these are identical. They have the same gamma, the same theta, the same vega in terms of being short gamma, long theta, short vega. You can see that our limited potential gain on the way down is basically due to the fact that we have a short gamma. As the stock trades down, our short stock is going to run into a little bit of a wall, because as the stock goes down, the puts delta will increase. That is going to increase by the amount of gamma. Eventually, the puts delta will go from 50 to 100. Once it's 100, we're going to be short an in the money 100 delta option. That option being a put is going to make us long, right? Whoever owns this put is going to put the stock to us. So what we really have at that point in time is a short stock position and now a long stock position. That's what makes this position limited in terms of its ability to make money on the downside. So we don't have a lot of room for capital appreciation here. The true value of this position is the premium collection. Synthetics. The covered call was the same as being short the corresponding put. The covered put is the same as being short the corresponding call. Remember your synthetics here. We did that whole section on synthetics. Short put plus short stock equals what? Short call. That's what we have here. The covered put position, the strategy itself, is nothing more than a synthetic position, the short call synthetic position. That's all it is. So we can price this position by the call. We know that synthetically we're short the call. That means the real call should have the same overall effective value. Take the call, subtract the interest minus the dividend. That will give you the value of your covered put position. This way you can make sure that your put and your synthetic put are both in line with each other. We also know that there's two legs of the reversal here, don't we? We know that we're short stock. We know we're short put. That's the covered put. And being that we have two legs of the reversal, we're only missing one. If we're short stock and short put, that's like being short the call. What are we missing? The long call. What does that mean to me? Simple. It means that if I'm in a short covered put position and I'm short synthetically that call, then all I need to do to close this position out is buy the real call. If I buy the real call, it's going to put me in the reversal. I'm going to shut the position down. I'm only going to spend one commission, only have to deal with one bid-ask spread, and I'm locked down. I'm in that arbitrage, that position without a position. So how does the covered put work? If you notice, it works just like the covered call. The extrinsic value of the short option decays as time goes by due to theta. Theta is putting money in my pocket every day. That extrinsic value of that put is decaying every day, and that goes to me. The intrinsic value of the stock, which is short stock, the short intrinsic value, offsets any increase in the short intrinsic value of the put. As the put goes down, it's starting to lose its extrinsic value, but it's gaining intrinsic value. The delta is increasing. You might say, well, if that thing goes down too much, I'm going to owe a lot of money. No, you won't, because you're short the stock. The put's total delta will never exceed the stock's total delta. You have the short stock, that intrinsic value of the short stock is offsetting any type of intrinsic value that the put might gain. We've eliminated or offset, neutralized any of the intrinsic value of the put's ability to gain on the way down. What do we have left? Only the extrinsic value. If we only have extrinsic value left, then this truly is a game of premium collection. Now, the extrinsic value you collect, how can you look at that? What is that? Some people consider it additional profits, a little extra money they made that month. Other people see it as a way of lowering their initial investment cost. Hey, I shorted the stock at 30. Now that I just collected $2 more from premium collection, it's almost like I shorted the stock at 32. We can work our way into a better price of our short, a higher sales price, by bringing in that constant premium. Some people look at it as a hedge. Hey, you know what? Now that I brought in that $2, I'm protected if the stock runs up $2 on me. Doesn't matter how you look at it. All three of these are valid. All three of these are viable. They are the reasons that people do the covered put strategy. We know that we're going to sell the at-the-money put. We know that. And we can see the at-the-money put right there in red. Problem with selling the others, for instance, the in-the-money put, is that we don't have the chance to make too much money. Why? Because the in-the-money put has a ton of intrinsic value, but it doesn't have much extrinsic value. All we've basically done is flatten ourselves out. We've moved our break-even much higher, but we now have no money to make. There's no extrinsic value in that in-the-money put. There's nothing for us to collect over time. The out-of-the-money put, that looks like it has a little extrinsic value, but very little. And the stock has to move a long way for us to really see any type of collection here. We have more room for capital appreciation, or in this case, because we're short the stock, capital depreciation, but we're not collecting any type of premium because the out-of-the-money option is so doggone cheap. All we're collecting is a little bit, hoping that we really get movement in the right direction from our short stock. Where the real premium is the at the money. That's where we're going to collect real premium. We might have a lot more protection in the money. We might have more room for capital appreciation in the out of the money. But we're not looking for protection because we don't care about our hedge. If we wanted to hedge this position fully, we would have never done the covered put. We don't care about the extra capital appreciation or depreciation in this case. What we're looking to do is to collect premium. If I wanted more capital appreciation, I wouldn't have done the covered put. So why are we doing the covered put? The proceeds from the sold put is income. This is an income generation strategy. Now you might say, well, why would anybody be short stock over a long period of time? Well, maybe we run into a bear market, one that lasts more than just a month or two. And if we run into a longer term, slower grinding bear market, you're going to need the covered put strategy. You're going to need to collect premium, and you're going to need to generate income. We profit from stagnation here. Not only are we benefiting from the stock going down, but we're also benefiting from the stock not moving. If the stock doesn't move, fine. We're still collecting our premiums. We're still making money. Like the covered call, the beauty of the covered put is the fact that it increases our probability of profit. We've got a better chance of making money, especially in the highest probable area of stock outcome. We profit with the stock down or unchanged. Think about it. If I just went and shorted the stock, what do I need to happen for me to make money? Stock has to go down. If it doesn't go down and stay still, I'm out commission costs, I'm out bid-ask spread costs, and I'm also out opportunity cost. The money that I'm wasting on this strategy could have been making me money someplace else. That is a bad thing. So staying still is not good. Stock going up against me, that's going to definitely lose me money. So when we're trading straight stock, especially when we're talking about shorting it, all we have in our favor is one thing, and that is the stock has to go down. But if we use the covered put strategy, we increase the probability of success. Why? Because now, not only can we profit from the stock going in the right direction, down, but we can profit if the stock stays still. Now that stagnant scenario, that I'm not moving scenario, now that's a profitable scenario because we've collected premium. The other thing is just say the stock goes against us, just a little bit. Depending on how much premium we collected by selling the put, we might have collected enough premium where even if the stock went against us a little, it went up, we might have collected enough premium to offset that plus make a little money. Let's say the stock went up against us $1, but I sold the put for $2. I might lose $1 in my stock position, but I've made $2 in my put position. I'm a net winner still, even with the stock going against me a little bit. Obviously, if it goes against me big, I am going to lose. Here's that chart again. That chart with the bell curve drawn right above the stock price. Take a look at how the covered put in red performs against just a plain old short stock position in green. And look at that first standard deviation area. That area right in here, where the stock is most likely to be at expiration. 70% of the time, exactly 68.4 for all you mathematicians out there that are going, he said 70 and he should have said 68.4. Fact of the matter is, if the stock stays right there, the covered put dramatically beats the straight short stock position. And it does it by a decent amount. It even wins on the way down up to a certain point. If the stock starts going up and we're losing money on the stock, and we're going down, we're losing money, oh my God, I'm losing money, we know at least part of the way in the covered put, we're protected. We have the premium coming in protecting us for at least a little bit. Once the stock gets above that spot, that break even, yeah, we're going to lose dollar for dollar just like the stock would. But the higher probability is seen right here in the bell curve. We have more chances to win in an area that is more than likely where the stock is going to finish. So when are we going to use these covered puts? Well, the covered call had a specific time and place and charting pattern that was advantageous to use the covered call. That was a long-term, slow, grinding uptrend. Covered put, same mechanism, just the other way. If you think of it that way and you're having trouble putting your hands around the covered put, think of covered call and then look in the opposite direction. When we're anticipating a longer-term, slower downtrend, that's when we use the covered put. It's good to jumpstart performance of a short stock position. There are times that we should be short. And when we're short and the stock kind of slows down and isn't really moving much for us, we can always throw in a short put and go with the covered put position. It jumpstarts the performance of that position. When we're looking to generate income, instead of drawing down on our little nest egg. Remember, in your portfolio, you might have stocks that are long and stocks that are short. You can't just think that the stocks that are long are the only ones that can generate income. That's not true. Our short stock positions can generate income also. Instead of selling a call against the long stock positions, sell puts against the short stock positions. This way, instead of drawing down on our principal, we're using the principal to generate income. That becomes very important in your retirement years when you start thinking, oh my gosh, I'm in pretty good shape and my money's running out. Well, guess when I turn 89 years old, it's back to the construction site. It's going to be tough hauling, cinder blocks up 13, 14 stories when you're 90 years old. We don't want that to happen. Keep the principal intact and create income from the principal instead of drawing down on the principal. The covered put is also great to use when we have a negative put-call skew. Remember, if we have a negative put-call skew, that means the real put is trading higher than its corresponding call. Don't sell the call, sell the put at the higher volatility. Sell the put, sell the stock, and you've created a short call position in an option that has a higher volatility than the real call. You've got a little volatility arbitrage there. Now what we want to do is take a look at how we find these type of downtrends. Remember, just because a stock trades down a little bit doesn't mean it's in a downtrend. A downtrend is something that's a lot more lasting, a lot more longer term. And there are specific ways of finding that on the chart.
All right, covered puts.
There you go.
You feel good?
I feel real good. It's just the opposite of covered calls.
Well, you did a great job.
Well, thank you very much.
And today's opposite day.
And today is opposite day. I should sit where you're sitting and you should sit where I'm sitting.
All right, you want to switch?
Maybe later.
Okay.
But, the one thing I want everybody to take away from this is the fact that if you can't grasp the covered put, then just flip it over and you have a covered call.
Right.
So if you understand covered call, you have to be able to understand covered put. It's the same mechanism.
It's the same thing when the stock's in a different direction.
That's simply all it is. Now, with that said, it's time to teach them how to find downtrends. And I'm pretty sure you're going to show them that a downtrend is like flipping an uptrend over.
Right. It's the same exact thing. Basically, the way that you're going to identify the uptrend line is the same way that you're going to identify the downtrend line. And so, without further ado, shall I go?
You should go do.
Good. So I'll show you how to identify the downtrend. Of course, you have the covered put, which is pretty much the opposite of the covered call. You're short the stock, and you're selling the front month at the money, or possibly slightly out of the money, depending if you're a little bit more bearish on the stock. Let's take a look at a downtrend. Here's GMX Resources, natural gas company. I actually participated in the IPO. I brought these guys public years ago. And you can see that you have one top right here that you can connect to another top. You're drawing a downtrend line. A couple other things that you look for in a downtrend, after you extend this downtrend line out, you can tell that's probably the most likely time where the stock's going to turn around and move lower again. A lot of people are all focusing on this part right here because millions of people out there drew the same line that we drew right here. So it could become a self-fulfilling prophecy when they see that the stock moves up to this trend line again. That's the opportune time to come in and take a bearish position. There are other things that are going on here. First of all, you can see that the stock found some support just above this level right here, and you can see that you can draw a horizontal support line, which is what this green line is. And this becomes a descending triangle. And a descending triangle is just a continuation pattern. Once the support level is broken, that's when you know that the trend is going to continue. It's confirming that the trend is going to move lower. I circled this part right here because you can see that this support level that was found here was actually violated, and that would be a red flag when you're looking down here in the future. Now, this looks like a short period of time when you're just looking at the chart, but this is actually 2 months. So the fact that this support level was actually violated here in the beginning of December is sort of a red flag that it's more easy for that to happen in the future. It makes it a lot more likely that the support level is able to be violated. Something else that you want to look at, whenever you're studying a chart, you want to find lots of different signs that the same thing is going to happen. You want to find a lot of different flags pointing in the same direction. So what you want to do whenever you look at a chart is you want to establish where the horizontal support and resistance is, and you want to find downtrend lines or uptrend lines or both. Also, one of the key things to remember is old support becomes new resistance, and new resistance becomes old support, and we'll talk about that in a little while. But when I said to take a synergistic approach, you want to use a lot of the different indicators and use them in synergy with each other. You see there's a downtrend line here. It's also a chart formation that we know is bearish, which is a descending chart, which is a descending triangle. But at the same time, what's this crazy squiggly line right here? That's the 50-day moving average, this brown line that you see. And as you know, GMX is obviously in a long-term downtrend. And you can see any time the stock gets up near the 50-day moving average, you can see it starts to move lower. Now, as I said before, that's another self-fulfilling prophecy because a 50-day moving average is one of the most popular moving averages that traders follow. So when people see that the stock is up near the 50-day moving average and they know that GMXR is in a long-term downtrend, that's when the short sellers are going to come in and actually push the stock lower. This is the opportune time for them to take their bearish positions. So you can see it all coincides with the downtrend line that we were talking about before. And you can see that the descending triangle starts to come to a point, and that's when the stock starts to tank. So that's when you want to take your position and write your covered put.
To see how Ron selects options that match Chris's strategy, visit the members section at optionsgps.com.
So you're back.
Yes, I am. I'm bad.
Well, I understand that, but that was a real good description of a downtrend, and I like how you kind of related it in common to an uptrend in the other direction, which, you know, at some point in time, you don't think that way, and I'm sure you don't sit there and say, oh, wow, is this a downtrend? Let me see if it would look like an uptrend. I'm sure that, you know, with your years of experience.
Same thing.
Yeah, I mean, and you don't even think of it. No. But a lot of our viewers out there, for them, the uptrend is something they can find easily. Downtrends are more difficult. And you know, this way you gave it a real good description of how you do both.
It shouldn't be about, you shouldn't think about it that way, more difficult when it's moving down. It's just, is the probability of the outcome high probability or low probability? If you have a high probability outcome staring at you, it doesn't matter if you think that the market's going to move down or up. If there's a high probability that you're right, then you want to take advantage of it.
Well, that's, we've been talking about the fact that, puts and calls are the same thing.
Yeah.
And for those people that have trouble handling puts, you look at the call and then just flip it over. And that obviously is going with, technical analysis too.
Mm-hmm.
Just the same rules that apply for something moving up have to apply for something that's moving down. And, now that they've identified that opportunity, a downtrend, and they say, hey, let's put the covered put on here. Now it's time to start managing the position and handling the variables.
Well, you want to be able to take advantage of it as long as the odds are stacked in your favor. When there are a number of things that are all telling you that the same thing is likely to happen, that's when you act. Bullish or bearish doesn't make a difference. You want to make money. We're here to make money, right?
That's the bottom line. Everything else doesn't matter.
All right, very good.
Ultimately. So I'll go start showing them how to morph and roll the covered put strategy, and you'll hang out here.
Morphing and rolling.
Morphing and rolling.
All right, good.
Lions
So when the variables change, when the stock moves up or down, in this case we're talking about down, all the other variables in the options price change. You want to make sure that you're positioned in the most ideal way to take advantage of that.
Yeah, the thing is that anybody who thinks that the trade that they put on is going to go their way perfectly every day, all the way out to whenever, is fooling themselves.
Right, they haven't invested ever before.
Yeah, that's pretty much, and they have a rosy idea of investing. That's simple. But the fact is that the best traders, the people that are consistently profitable, like you, they make adjustments as the stock changes, as the situation changes. And when we talk about the rolling and morphing of these positions, it's because we know things are going to change. And if we're prepared for them ahead of time, and we know what can happen and then what I'm going to do, then when it comes time to have it happen, you're a lot more confident, you're quicker to do it, and you're not, making decisions in a panic.
Right.
The decision was made beforehand when you weren't panicking.
Right. Well, I think it was Warren Buffett who said, risk is not knowing what you're doing.
There you go.
So now we're going to know what we're doing when we're rolling and we're morphing.
The covered put strategy.
Go roll and morph.
I'm going to go roll and morph.
Okay.
Well, now we're ready to set up the trade. So let's go ahead and set one up. First thing I'm going to do, after the proper technical analysis and fundamental analysis, is I'm going to short 100 shares of stock in whatever stock it is that I chose. Now, for every 100 shares I sell, I'm going to sell one put. Short put, short stock, 1-to-1 ratio. Now, I'm going to remember that I'm selling the front month at the money put. Why? Because that's the one that's going to decay the most. I don't want to sell the out month. I want to sell the front month over and over and over again. So I'm going to sell the front month at the money put, or if I have to and the stock is kind of in between strikes, I can sell the slightly out of the money put. The key is I've got to do this put selling month in and month out. Every month, month to month. I can't take months off. In the same way that we couldn't take a vacation with our covered call strategy, we can't take the vacation with the covered put strategy. Every month, like clockwork, we've got to sell our put. Now, you might say, hey, what about if vol's not too high, like vol's real low? Remember, volatility being low means that there's not going to be as much value in that put. I understand that. But vol being low is indicating that the stock is less likely to move, which means that although you're collecting less money by selling that put at a lower volatility level, you have a better chance of collecting that money, higher probability of success. When vol's high, oh yeah, it looks real rosy. Oh, look at how much premium I'm collecting this month. Vol's screaming and I'm selling these puts. Okay, there could be a nice big payday there for you. But do understand, vol's high for a reason. There's serious uncertainty in the market. There's some risk in the market. Your potential chance or probability of collecting that whole big premium that you were all excited about isn't too high. So that's why when vol's high, we're selling it. When vol's low, we're selling it. Either I'm going to collect a little bit and be really sure I'm going to get it, or I'm going to collect a lot and take my chances and hope I get it. But we're going to sell every month like clockwork. So let's take a look at an example. And this example, we're going to look at the at-the-money covered put. We're going to short the stock at 60, and we're going to sell the 60 put for $4. Remember, 1-to-1 ratio here. Our maximum gain is $4, the amount of money we're bringing in from the sale of the put. Our break even is 64. Why is that? Because we said that the break even is the stock price plus the put price. The put is going to cover us for an adverse movement up in the stock. That's why we have to add the put price to the current stock price. That gives us 64. Our maximum loss is infinite. The stock price trading all the way to infinity. Remember, in the covered put position, we lose dollar for dollar above 64 as far as the stock can go. And that is to infinity, theoretically. Now let's take a look at an example of an out-of-the-money covered put. Let's short the stock again at $60. But this time, let's sell an out-of-the-money put, the 55 put. And let's say we get $2 for it. Our maximum potential gain is $2. Now you might say, well, wait a second, Ron. What if the stock traded down to 55? We would make the $2 from our put because the stock is down at the strike of the put. The 55 put with the stock at 55 would be worthless. We make our $2. But you're forgetting the stock. You sold the stock at 60. It's now at 55. Wouldn't you have made $5 in the stock? The answer is yes, you would have. But are you willing to take it? Because remember, the covered put strategy is a premium collection strategy. It was designed to be something of a longer term strategy, collecting premium month after month after month. If we're going to continue this position, then we're going to overlook the capital appreciation of our short stock. We're not going to take it, so we can't count it in. Don't count your chickens before they're hatched. Until you close that out, you don't have it. Now, if you told me, well, you know what, with that movement, I'm out. Fine, then you're out. You've got a $7 profit. But do understand something. That's based on the idea that you did the out-of-the-money covered put for a reason. Whenever we do an out-of-the-money covered put or an out-of-the-money covered call, what we're doing is we're accepting less premium to have more room for capital appreciation. Our break even here is going to be $62. $60 stock price plus the put price, $62. What does that make our maximum loss? Infinite. Why? Because from 62 all the way to infinity, we will lose dollar for dollar in this position. The out-of-the-money covered put is a neat little concept if we're thinking about doing something a little longer term, but leaving more room for capital appreciation. This is not the premium collector that the at-the-money covered put is. Now let's take an example of a in-the-money covered put. When we do an in-the-money covered put, remember, we're not just selling extrinsic value. We're also selling some intrinsic value. Here, we're going to short the stock at 60, and we're going to sell the 65 put for $7. The 65 put is $5 in the money. That means that we're going to sell $5 of intrinsic value. We also have $2 of extrinsic value. Our maximum gain is the extrinsic value that we're collecting. Our break even is going to be the stock price plus the option price, total of $67. Our break even is 67. Our maximum loss is our stock price to infinity. That means from 67 to as high as the stock may go, we're going to lose dollar for dollar in this position. One of the things that you have to see and understand here is that when we do an in-the-money covered put strategy, we're going to have a lot more protection, meaning that Our break even is going to be much higher than if we did an at the money or an out of the money covered put. The problem is that our gain is much smaller. This might not be a bad idea on occasion when the stock is at the top of its range, but still in that down channel that we need for the covered put. What are our keys to success? What type of things do we need to do consistently to make this strategy profitable on a regular basis? Always, we need to know where the stock is going. The one thing I've learned in a lot of years of trading is once I know where the stock is going, everything else becomes very easy. Solid technical and fundamental analysis of the stock makes it a little easier to understand where the stock is going and how it's going to get there. Understanding that allows me to understand where the options will wind up. We have to sell these puts every month. When we talked about the covered call strategy, we said that was a strategy that was best used in a longer term situation, but that we were selling every month to month consistently, compounding our returns by selling premium. Everybody wants to get that last drop out of their short option. They want that last little drop of extrinsic value. That's not necessarily the best idea. That last drop doesn't occur until after expiration. At 4:10 on Friday, we'll see that last drop. The only thing is quite often we'll be short an option that has very little extrinsic value left and wonder, hey, why didn't we buy it back when we could? Because then the stock moves and boom, there's more value in that option. Remember, we don't have to get the last drop of extrinsic value out. We're short an option and we are taking risk. The only reason we might be short an option, such as a put in this covered put strategy, is to collect premium. If there's no more premium left, or if there's very little left, then it's not worth the risk of being short the option. Take it off and find another option with heavy extrinsic value to sell. And hey, don't worry about buying the put back for a loss. Remember, just like with the covered call, if I have to buy back my short option for a loss, I'm happy. I did a good job. I maxed out my position for the month. Buy that put back, lose on the put. You made much more money on the stock position. So let's take a look at trading this covered put. What if the stock goes down? That should be a good thing, right? First, we have a potential roll. If the stock is going down and we have a quick down movement, we might be able to roll our put down in the same month. That means we might collect 2 premiums in a single month. Obviously better than 1. We also know that we have to roll at expiration. We always have to think about what am I going to do next month. When expiration gets here, if the position is working, obviously with the stock trading down it is working. If the position is working, I'm going to want to continue it. How do I continue it? I've got to get out of my front month option that's expiring and then sell the next month at the money option. That at the money option might be in the same strike I'm in now, and I'll have a horizontal roll. However, if that next month's at the money option, because the stock moved, is different than the strike I'm short now, I've got to buy back my strike and then roll diagonally and sell the next month's at the money strike, even if it's not the same strike I'm short now. What about morphing it? Well, let's think about it. If this is working, if the stock is going down and our covered put is working, why would we want to change that position? We might want to continue it, but we sure as heck don't want to change it. It's working. Be patient with the position. What about closing it? Well, at some point in time, we're going to want to close it. But when the position is going our way, we want to make sure that we stay in it and ride it for as long as we can. As long as the stock remains in that downtrend, the covered put strategy will work. Now, if it does something else, then we have to reconsider. But this, according to the stock going down, is still in our downtrend. This position is still working. There's no reason to change it. There's no reason to close it. let's take a look at our rolls if the stock started heading down. The first roll we have is a vertical roll, which means that, hey, the stock was at 65, stock started trading down, it traded down relatively quickly. What do? I buy back my 65s because there's probably little extrinsic value there now, right? They were at the money, but with the stock trading down, they're suddenly, what? Out of the money. And if they're out of the money, they don't have enough extrinsic value for me to justify being short an option and taking on the risk of a short option. Buy back your 65s cheap, sell your 60s, collect another round of heavy extrinsic value for the month. So here we are at June expiration, and we're short the June 65 put. The position is working for us. The stock has gone in our direction. It's gone down. What we want to do is we want to continue this position. Remember, if the position wasn't working, we might think about closing. We might think about morphing. But here the position is working for us. We want to continue with that position. The covered put, like the covered call, is a strategy that's best used in a repetitive fashion. So what are we going to do at June expiration? We're going to buy back our June 65 puts and sell the July 65 put and play this whole game all over again for the month of July. But what if the stock goes up? Remember, the covered put strategy works best when the stock goes down. What if it goes against us at some point in time? Well, there is a potential roll. We might want to roll up against the grain if the stock is still in a downtrend. Remember, just because the stock is in a downtrend doesn't mean it'll never move up. We have to make sure that if we're going to do this when the stock goes up, if we're going to roll against the grain, we have to make sure that we're still in the trend. Remember, stocks don't just go up by going up every day, every tick. Stocks don't go down by going down every day, every tick. What they do is they kind of bounce around. If we're bouncing around in our downtrend and we have a little bit of an up movement, which is going to happen frequently, then we consider rolling. However, if our stock up becomes a breakout, breaking the trend, breaking the downtrend, then we have to do something else. We've got to change our position. So remember, if we have a situation where the stock is trading up against us, and we have a little bit of just a little bounce, but in the trend, we're still in a downtrend with the stock moving up, we can roll. If by chance this stock going up breaks the downtrend, violates that resistance level, and breaks out, then we need to change the position. And in that case, we're going to change it to a bull put spread. We're going to morph our position. We're going to change this covered put that takes advantage of the stock going down. We're going to change it into a bull put spread, taking advantage of the stock going up. But that's only if it breaks the downtrend. Now remember, we also can close at any time. If the stock is going against us, we can just simply get out. What's that saying? When in doubt, get out. If the stock isn't cooperating, maybe we just had a bad read, maybe new news came out. I don't know what could have happened, but you will have bad calls from time to time. When we're in the covered put and the stock is going against you, meaning going up, we can always just simply close out. And when I say simply, I mean simply, because remember, we have two legs of the reversal here. We're short stock and we're short put. What is that other leg of the reversal? Long call. All we need to do is buy the corresponding call, that puts corresponding call, one trade, boom, out, easy, simple. We're now in the reversal. It's an arbitrage. It's a position with no position, and we're out. Don't be afraid of locking down losses. Sometimes they happen. The best traders I know are very quick to admit that they're wrong and lock down their position and reinitiate a new position. Let's take a look at this situation here. Here we are with the covered put situation. And we're short stock and we're short put. What can we do if the stock starts to run up against us? The first thing we can do, very easily, is buy the strike that is lower than our short put. We were short the stock and short the 65 put. Remember, that's like being short the 65 call. If we bought the 60 call, then what we have here is now a bull spread. Short the 65 call synthetically, long the real 65 call, we've got a bull spread. And what can the bull spread do? Well, it can turn our covered put strategy that's wrong because the stock's going up into a strategy that is going to make money when the stock goes up, the bull spread. We can always close. There's never a problem with closing. We're short the stock, we're short the put. We know that that equals short the corresponding call, short the 65 call synthetically. Simply buy the real call and we can shut this whole thing down with one single trade. Boom, we're in the reversal. Now, what if the stock stays still? That's a good thing, isn't it? Remember, the covered put, like the covered call, is first and foremost a premium collection strategy. We're trying to collect the decay of the extrinsic value. If the stock goes sideways, that option is just going to decay more and more every day. What happens then? We collect money. That's the idea. Remember, premium collection. So the stock staying still is a good thing. When things are good and we're making money, do we want to change them? Do we want to close them? No, we want to continue them. So what are we going to do? We're going to look at a roll. When we come up to expiration, we're going to want to roll out, to move out another month and play this all over again. What about a morph? Well, what about a morph? It's working. Why are we going to change anything? So many people are so quick to change things. They don't have any patience. This position is working if the stock goes sideways. There's nothing to change. There's no reason to change it. Let's let the position work. And finally, close it. Well, we could just get tired of the position. We're making money slowly, steadily, on a regular basis. Sure, let's get tired of that and do something else. Don't shut down a position that's working. Let it work, let it go. So what are we going to do if the stock stays still? We're just going to simply roll out and play it again in the next month. Okay, so let's look at what we're going to do with the covered put strategy if the stock stays still. It's working. We're here, we're short the June 65s, we're coming right up on expiration, we've collected good premium. What's the move we make? Simple. We buy back our June 65s right on even expiration day if you wanted to wait that long. Remember, the longer you wait, the more you collect. And we just roll it out to our July 65s and play this all over again. The stock staying still is a good thing for premium collection strategies. Well, that's about it for the covered put. And we're got to remember that for all of you that have trouble trading puts, whatever strategy that involves a put, just think about how the call functions. If you remember how the call functions, all you have to do is turn things the other way. A put is going to function on the downside the same way that the call functions on the upside.
Well, that was a great explanation, Ron. Good job. Now that you've covered puts and covered calls, you're ready to move on to the next section. But before you do that, you know the routine. I want you to go to optionsgps.com, go to the community. Maybe you can answer a couple of questions there, ask a couple questions if you need to familiarize yourself with the materials just a little bit more. And then I'll see you on the next DVD, which is Protective Puts.
Now, in the same way we talked about that slow grinding uptrend and using the covered call, the covered put is going to work the same way, except what's it going to do? It's going to take advantage of a slow grinding downtrend. We've got a short delta position here. And Chris has found us a slow grinding downtrend here in GMX Resources, GMXR. So now that we found this slow grinding downtrend, what are we going to do? If we're going to apply the covered put strategy, the first thing we have to do is short the stock. And we need to know where that stock price is. Circled here in red, the stock price last sale $18.37. We know that when we're in a covered call or a covered put and premium collecting, and this is true for every premium collection strategy that we're going to use from here on out, we must be selling the front month at the money option or slightly out of the money. The reason I'm saying that is because here's one that's going to be slightly out of the money. So what do we have? Well, if we're going to sell the front month, today's date, December 5th, that means December is what we should be looking at. And we are. We are in the December strikes. We are looking at December. We also should be looking at the at-the-money strike. But with the stock at 1837, both the 20 and 17.5s are kind of at the money. If you take a look at the two of them, both are going to have about the same amount of extrinsic value. Problem is, the 20 strike is also coming equipped with intrinsic value. Intrinsic value doesn't decay. And if we sell the 20 put, we're actually going to pick up 56 long deltas, as opposed to only picking up 39 long deltas by selling the 17.5 put. Because we're expecting the downward movement, I would rather short the stock and sell the put with the smaller delta as long as I can gain the same amount of extrinsic value, which I can. The intrinsic value in the 20 strike works against us as a positive intrinsic value when we're trying to play downside. We don't want to do that. So what do? We sell the 17.5 strike. There's a $1.80 bid there. We would sell that 17.5. If the stock continues down, we could always roll down to the next strike and continue picking up premium. The stock going up is going to hurt us a bit. However, with the pickup of this premium here from the 17.5 put, we do have some room for the stock to trade up against us before we reach break even. So the stock could actually trade up a little, yet we could still wind up profitable even though the stock is going against us. That's one of the things that premium gives us. Premium also serves as the decrease our entrance price. Because if I'm picking up an additional $1.80, I've just lowered the total cost of my trade by $1.80 down from $18.37. So remember, whenever you're doing a premium collection strategy, you're selling front month at the money or slightly out of the money to get your best effect.